What's going on, ladies and gentlemen? Welcome back to the Successes Within Reach podcast. I'm your host, Shannon Smith, also known as the CEO Within on Instagram. I want to welcome back our guest for today, Mr. Jay Allen, my brother. How you doing, sir?
I'm great, Shannon. How you doing, brother?
Can't complain. So last month, well, a few weeks back, Jay Allen came on. Hit you all with a bunch of gems, a bunch of gems for your credit, finance, balancing your budget, saving. You wanted them back. He's here for episode 5. We have finance and credit conversations with Jay Allen once again. I hope you all are ready. For those that want to tune in with questions for Mr. Allen, you can join the conversation and submit your questions to www.facebook.com/SIWR podcast. All right, you ready, sir? Let's get it.
Yes, sir. Let's do it.
All right, first up, what is debt to income ratio and how does it impact your credit?
Good question, Shannon. So I'll start here with the basis of it. Debt to income ratio is the percentage of your debt, whether it's household debt or all your debts together, as it relates to your gross income, right? So before taxes. Now, there is a back end and there's a front end. So this is really big in the mortgage industry, and based on your lender, it depends on which one they use. Some weigh heavily more than others. So your front end is going to be the percentage of your mortgage payments, interest, basically your mortgage payment monthly to your gross income. And usually they want that to be around 28% for a mortgage lender at the max. Now, for an example, that would be if you make $10,000 a month gross income. So this is pre-taxes, right? The front end ratio should not exceed 28%. The back end ratio is the household debts plus car loans, student loans, anything that shows up on your credit report. They usually want that to be between 40 and 45% most times. Now, it doesn't affect your credit necessarily in terms of credit scoring model, but credit is a factor in the underwriting process. Now, the 28% and the 45% can be, I won't say it's negotiable, but credit is not an absolute science in terms of it has to be the exact number. So if you are someone that has a DTI, maybe say 47%, but you have strong income, you also have good credit on file, and you have maybe money in the bank saved up, that's going to help mitigate the risk of you defaulting on that loan. As an underwriter, our job is not to eliminate risk, it's to mitigate risk. The way we make money in the lending industry is to lend money and receive interest back. Okay, so we don't want to eliminate the risk. We want to, create a portfolio for the risk and be able to assess that risk based on your overall credit profile. And in the mortgage industry, which I'm not in the mortgage industry, by the way, but just talking to people that I know and just in finance in general, DTI is a huge part of that equation in regards to getting approved for a mortgage. Now, but I do want to add as well, I did say mortgage payments, I said car loans, I said credit card debts, right? These are all things that are going to show up on your credit report. These are all things that a lender's going to see. Don't get fooled in thinking that you need to get approved and buy the house that you qualify for at the max level. Because at the end of the day, what they can't see is all your frivolous charges. They can't see your subscriptions that you're paying for that you don't tell anybody about. They can't see maybe the 401k loan that's not shown on your credit report. They can only see what's visible to them and what you show them. So you want to be budgeting so you can know what you can truly afford on a monthly basis and not just go off the DTI. But knowing those numbers in advance help you be a more informed consumer going into that bank, trying to get that home loan.
Got it. Got it. Once again, I want to remind you all, if you have any questions that you want answered on credit, on finance, you can drop them in at www.facebook.com/SIWR podcast. All right, next up, which do you recommend for big ticket purchases, a regular bank or a credit union, and why? You know,
Right.
people go to get a house, they try to go get a car, take out a major loan, maybe for something else. And, you know, some people say, no, go check with your credit union. And then some people say, well, no, go to a bigger bank, they can offer you more. So which one do you
Right.
think is the better option for big ticket purchases?
That's a great question. It's one I hear a lot, honestly, Shannon. So before I move forward, I did a bad thing just now. I didn't tell who I was, my background. So as Shannon mentioned, I am Jay Allen. On episode 2 with the Shannon's podcast, and I'm glad to be back. You know, my background is finance, credit, underwriting, things of that nature. For the past 15 years, also own a credit restoration business called Allen Financial Solutions. The email is going to be dropped below. And I'm the co-owner of Boss Hall Logistics Incorporated. LLC, a company that runs dry freight for Amazon in the Northeast. So just kind of my background and why I'm here is because of just a lot of experience in the industry. And I love to share with you what I have over the years to help you be a more informed consumer as you're out here, making these large purchases. So in regards to credit unions versus banks, it's a lot of questions you want to ask yourself. What level of service do you want, right? Are you looking to have access to ATMs all over the country? All right.
Mm-hmm.
What kind of financial products do you want or what you need or what you grow into? And what that means is, most banks or credit unions are going to have your basic loans, credit cards, things of that nature. Based on your business model and what you do, you may need, lines of credit that are secured lines of credit. You may need unsecured lines of credit. You may need revolving debt, capital loans, and things like that. And some credit unions don't have those type of products. So you want to figure out what you're going to need long term because you want to grow into that bank. Now, if you're just looking to go get low interest rates, all right, because a credit union is actually a nonprofit organization where the members or the clients are members of that credit union. So not really going to be, they don't feel the same pressure as a bank. Sometimes like Bank of America, Wells Fargo, they have stockholders. So they have to have a certain return. So their rates are normally higher in order to provide to the market what the market needs to keep buying that stock over and over again. So in terms of good customer service, a smaller field, credit unions usually support the community as well. They're kind of more of a niche market where they are. And then, like I said before, low interest rates. I took a few more notes as well. And they usually also pay higher interest rates on deposits. So savings accounts and things, CDs, things like that. For a large ticket purchase where I'm just looking to do business with them, not necessarily, use ATM a lot and really want to dig in and have good service and feel like I'm one-on-one with someone, I'm going for a credit union, especially being someone that's newer in business. Now, what you do is as you grow with the credit union, you may outgrow the credit union. In that case, you may need someone more sophisticated in your space or in your industry. And you may go to a bank. But a few questions I did write down to ask both the bank. I think as consumers and as clients, we have to remember that we're the customer and we have the right to interview them. So we're in control. So who do they report to? Because some credit unions do not report to all 3 credit bureaus. Most banks do, not all banks do. And that can hurt you because let's say, for example, you with a small credit union in your hometown and they report to TransUnion only, but you never ask that question. And then you venture out, say, to another state, another city to buy real estate, and you want to do local business with a local bank, and they pull Equifax. They can't see your credit history that was reported through a credit union because they never reported to other bureau. Because people don't know this sometimes, but credit bureaus are for-profit organizations. They charge banks, institutions to report to them. Some credit unions in an act to save money so they can then pay out high rates on loans. I'm sorry, on deposits, things like that. They may cut back on certain costs. So you want to understand the full gambit of what you're dealing with. Or if they won't report to your credit bureaus, will they provide a letter of credit to others on your behalf? So when I was in underwriting, I had a lot of customers that had Wells Fargo, right? And I a letter of credit from the bank or a letter of deposit showing that they had money in that bank. Well, Wells Fargo charged $25 per credit reference. My company said, and that. So it's on the consumer to call Wells Fargo to get that letter of credit paid for and then sent to me. So how easy are they to do business with? I think in most categories, you're going to fall in line with the credit union. Now, there are big banks with a small bank feel. And that's why I always recommend interviewing, getting the feel, and seeing how it works for you best. But like Lakia said, credit unions are usually going to be best to me in that case. I'm big on service in general.
Gotcha.
Yep.
Gotcha. Yeah, I didn't even know that myself, that all credit unions don't report to all 3 credit agencies. Like, I hope y'all are taking notes on this. Like I told y'all, Jay Allen gonna drop some gems for you. That's something I had no clue of right there.
And also, Shannon, not all banks do either, but it's more prominent among credit unions because they're usually going to be regional in nature. They're just in one city. So like I said, they may be trying to conserve cash. Most of the customer base is maybe in a city or a county area. A larger is going to usually spend that money to report to all 3 bureaus on your behalf. But it's always good to ask the question. And I'll give you an example. I did a seminar down in Charlotte, North Carolina, about 18 months ago, 2 years ago. And a young lady there had did all her business with one local credit union forever. And now she's trying to expand out and she's needing things that they can't offer her. Internally, she's going to other banks. But unfortunately, the report that they're pulling is not the one that credit union reports to. So now she's having to provide more documentation. She has to provide more proof of income, just more things to mitigate the risk and make that underwriter feel comfortable. Well, in fact, the credit union, if they reported all 3 bureaus, it would have been right there in their face.
Got you.
Yeah.
Got you. All right, this next one actually came from one of our viewers the last time that you were on, and I promised them I'd make sure I added it on this time.
Yep.
What are trade lines and how do they work?
So a trade line is simply a payment experience, right? It's so a car payment, a house payment, a credit card, that's a payment experience. So that's basically what a trade line is, right? So on average, what you want to have a trade line on file for is really 7 years. So it takes time to really build credit. All right. So and it really illustrates your ability to pay debt, or how we say in lending, to service a debt load. So it's a credit experience. It's building trust. So the example I give is that if I came to you and asked to borrow money, say $100, your first question is going to be, who else can I go ask about you and your lending habits? You can ask Mike, you can ask Kurt, you can ask Aisha, right? And you're going to go to them and you're going to look at my payment experience, my trade line with them, and see how I paid them. You're going to look at the length of history in that trade line. You're going to look at the payments, the payment structure. Is it net 30? Is it 30 days, 60 days? Was I late? And because you're looking for something that's comparable. So one big thing the trade lines do is they show what's called comp credit, which is comparable credit terms or comparable credit. So if I want to borrow $100 from you, but I've only borrowed $20 from everybody in my circle on a trade line, your level of comfort with me borrowing $100 probably gonna be pretty low. So then I got to bring to you more information, show you my income, maybe provide some collateral to secure this loan. So now, in terms of credit lines, and people ask me all the time about, authorized use and piggybacking. So let me go there. So you can piggyback on someone's credit in regards to inheriting their credit history as authorized user on your credit report. Some institutions don't report back in history. Some start the history reporting the day you sign up going forward. So you want to ask
Okay.
questions because they're not going to tell you that over the phone in most cases. All right. You can rent trade lines as well. There's a website called TradeLineSupply.com. I'm not into that space of renting trade lines, but I do have the ability to sell trade lines. And
Okay.
all I have is that I do have a rent reporting trade line that reports your rent to your credit bureaus. I have a security card through First Progress that also does report that as well. But most consumers also have the same ability and don't know it. Most credit cards have substantial authorized users that you can sell to someone if you want to. You know what I'm saying? Or you can put your kids on there. Now that becomes a business and it becomes tricky because you're dealing with people's personal information. Some
Mm-hmm.
a business model. I have not delved into that space. I do it for family, trying to rebuild and things like that. I don't delve into the industry of selling it on my own in terms of my own credit cards, but you can. Now, from a lending perspective, authorized users accounts are great to help build your credit score and to give you a thicker credit profile. Because there's two things in play here. You have a credit score, which is your FICO or your Vantage. Then you have your profile. Your profile is what really determines how much you get approved for. So
Okay.
we standing side by side and both have 780 credit scores. Now, if underwriter looks at our accounts at the FICO level, it looks to be equal with the same person on paper. Then they go deeper into our credit profile. They may see that my highest line of credit is 200 grand, where yours may be 35,000. So the
Mm-hmm.
level I'm going to be able to get approved for based off those factors alone is going to be higher. Now there are things that come into play like income and collateral and experience and whatever I'm doing, but just at a base level, those things are going to be things that are going to take place in regards to us being looking equal on paper and trade lines. So in terms of trade lines that you can get and be a primary on, self lender is always a good one. I like to use for my clients. It's self.com. You can go find a security card. I have one through my business through First Progress. You can also go to creditbuildercard.com as well. You can also go to myjewelerclub.com. And what I just learned about recently is Grain. Grain. This is a digital credit card in your app store. You can find this in your app store. No credit check, and it does reports to all three credit bureaus as well to help you build that credit. Because two things are important here. Length of credit takes up 15% or accounts for 15% of your FICO score, and credit mix, so revolving and installment loans account for 10% of your FICO score. Banks want to see you pay different kinds of debt back on time, makes you more trustworthy as well.
Gotcha. So with purchasing a trade line, if you get your report pulled and then they see that you have 20 years worth of credit on your report because you purchased this trade line, but then say the person is only maybe 25 years old, won't they know that you purchased the trade line?
Yeah, that's one of the things you want to be careful of is looking at the age of it versus your age. They're going to usually know
Mm-hmm.
if someone is really looking at it because when I used to pull credit, we used to pull, I think in my job, we pull, I think FICO 8 maybe. And when I saw that AU authorized user account, I used to mark those off. I took a magic marker and marked through them because I want to know primarily what you can do as a lender. I'm sorry, as a creditor.
Okay.
Well, sorry, as a consumer or as a client of mine. So, but in my business, I'm doing big ticket items. Now, a credit card may look at it differently. So, like someone at Citibank may say, "All right, I tell you, they're starting to build their credit profile. They have maybe one authorized user account and a self-lender account, and the authorized user account is maybe 15,000. Now, I'm not giving them 15,000 because this is they aren't the primary. They haven't demonstrated
Mm-hmm.
ability to service that debt load. I may give them 2,500. I may give them 3,000 to get them started, but they're still piggybacking on that original trade line of someone else, and they're getting the history. But it is going to be a red flag if a lender does see we're 5 years old and you have credit cards, so it's going to seem kind of weird. And they may just mark it out. Here's the thing too. If you call a lot of banks and you say, "Let me speak to the underwriter," they're going to say no. So sometimes you decline, and the reason that you get for being declined is going to be very, very vague. It's going to be very, very vague. And that's for a few reasons. One major reason is this: as a lender, we're not allowed to tell you what's in your credit report over the phone because the credit bureaus get paid for that, and we pay them to report. So we have an agreement with them. Most times, we can't just share with you because that's going to take away from their business. So I want to drop a nugget in there for you. Before you start applying for stuff, it's always good to know where you stand. I think your credit report or your FICO is much like your blood pressure. Like, you want to know your status on a pretty regular basis.
Got it. All right. Next one we have elaborate on the 5 C's of a credit analysis.
Yes, sir. So character. So I'm actually going to go 7. I'm going to go 7 here, and actually
Okay.
I pull some more up for you. That I want to start with. So, like, character is going to be like your credit history, and then if it's in the case of a business, it's going to be experience in that space. So if you never sold whatever product this is, or you trying this new industry with no experience, that's going to play into the character of that loan. And the underwriter is thinking, okay, how could they pay me back if they had no experience in this business? They're a lot risky in that space. And then financial competency, and business plan. How organized are you when you walk into a bank? That's crucial to a lender. When I speak to someone about their loans and they can't tell me what's going on in their business, that's a huge red flag for me as a lender. Because as a lender, like I said before, my job is not to eliminate risk, it's to mitigate risk. All right. Do you have enough money after you pay your bills, left over on your income statement? So do you have net income on a regular basis? And then capital. When you come in, what do you already own? What tangible assets? Obviously, cash is always going to be great to have on hand. Do you have the capital on hand, the equity in the business? And are you able to maintain that as well? And I'm kind of getting ahead of myself a little bit right here, because business credit is coming up in the future questions. But one of the biggest mistakes I've seen new business owners do is they do what they bleed the business. So you will be looking at their income statement, you will see revenues is $1 million, and then they're killing it, and net income is good, and then it's like, okay, you looking at balance sheet, it's like, well, where is the money going? Like, there's no equity in this business. And then you see owner withdrawals, right? So these owners are basically taking all the equity out of the business for salary purposes. So for a lender like myself, I look at that and I see absolutely no power in this business model or in this business. So you know what I want now? I'm going to condition, which is number 4. I'm going to condition this loan. I want personal guarantees. I want the owners to guarantee these loans. I'm giving them ownership, because all the power, all the strength is in the ownership. And sometimes people get caught up on the revenue of the business, and revenue is top line. It's just top line. That's not what you end with. And if they're not reinvesting it in the business, then the business is bleeding, and that's not the type of business that I want to lend to. So I'm going to want to condition it, which is the 4th C, conditions that loan for a personal guarantee, or I make a condition with high interest rates. But I want to, as a lender, be in the position to win no matter what, and I want to win faster than you do as the lendee or the leasee of that loan. And then collateral. What's backing the loan? What's backing the loan in terms of, is it property? Is it a building? If you're buying a car, obviously the easiest thing to think about is, if you go out and buy a car, that car is now collateral of that loan. And if you stop paying on that car, I'm going to come find that car, right? I'm going to charge you the repo fees. I'm going to charge you late fees. I'm going to charge you admin fees, and then I'm going to resell that car. I'm going to resell that car, and then charge you what's left over for the deficiency of that asset. Mortgage is a little bit different because most banks don't want to foreclose you because banks don't want to hold houses if they don't have to. They don't want to hold that asset. They want to be liquid, and they're getting their mortgage more and more. In my industry, heavy equipment, we try to give you a little bit more leeway sometimes, but we will repossess you. I've had to have people repossessed in previous roles. I've had to get U.S. Marshals involved. I've had to do bench warrants.
Wow.
I've had to do a lot of things to get stuff back from people who won't pay us our money or give us the machine back or the asset back, the collateral back. And then those 5 C's that people always talk about, online, you Google 5 C's of credit. But I've learned through my experience that the 6 C of credit is communication. The one thing as a consumer or a new business owner that you can't forget when dealing with a bank or credit union is it's a relationship. And
Definitely.
people like doing business with people that they like. And they also want to understand your business. So the more I understand your business model and your business, the more comfortable I am lending you money. That's a huge one. And then the 7th C, which someone told me recently I learned at work, is colon, right? Your gut. When I look at all these factors in this loan, how do I feel inside? Like what feeling do I have? Credit analysis is not an absolute truth. It's not an truth. It's subjective. I'm taking facts and data and I'm making it a decision based off facts and data. I always tell people if you sit me beside someone from Wells Fargo or from John Deere Credit or Citibank, and we could probably all agree on the basics of credit analysis, but based on our business's risk tolerance factors, we may have a different outcome in how we approve you. There have been times where people have been declined by my company and approved somewhere else at first based on their risk tolerance as an organization.
Gotcha. I hope y'all captured that. We asked for 5. Jay gave us 7. I'm telling y'all, he knows his stuff when it comes to this credit game. All right. Next up, what types of credit cards should college students look into to establish credit, and which cards should they avoid? A lot of people getting in trouble with this. You're an adult now, you leave to go to college, you can start getting all these offers in the mail. A lot of people just sign up for everything that they get. We talked about that a little bit the last time and end up getting in a lot of trouble early in their adulthood. So which cards should college students look into to establish their credit, and which types of cards should they stay away from?
So I'm gonna start with 2. So there are 2 that are out there that are specific for college students through Discover. So at a baseline, I think as a college student, you want to avoid anything with high fees, right? You also want to probably avoid anything that's going to require a FICO pool, because you're not probably in that space yet where you have credit on file. So Discover has a Discover It student cash back card, and it's a cash back card, no prior FICO history required, no annual fee. And what's cool is they give you $20, a $20 credit if you maintain a 3.0 GPA through the end of the year.
Nice.
Pretty cool card. They also have a Discover It student Chrome card, which is very similar, but just does not provide the actual $20 credit for your GPA. Those are 2 good ones to have. Low fees, interest rates range between 10 and 12% on those cards as well. And then, like I said before, no annual fees. Now, they do require some level of income for those cards. So in that situation, if you're not working, as a full-time college student might be or might not be working, then I always say security card. Whether that's First Progress through my company, whether that's going to be credit builder card, or go to your local bank and ask if they have a security card that they can ask you to apply for in the bank. The one card to stay away from is going to be a charge card, because I didn't realize that there were different types of cards. There's a credit card with an absolute limit, with a revolving line of credit attached to it with low payment usually as a percentage of your balance. And then charge cards, they kind of fluctuate the balance based upon your usage of the card and you paying it back. And the trick of that is, in some cases with charge cards, they want the balance paid in full each period. And I missed that in college, unfortunately, because I had a little bit of credit in college. My aunt put me as authorized user on her American Express when I was right at the end of high school, going into college, and then my grandpa co-signed for my student loans. So I was starting to build a little bit of a credit profile, and I messed around with them on campus. A guy had an application, and he had a coupon for free, I think either a free Subway sub or free Domino's pizza. And that's all it took for me to sign the application. And he told me in the mail, my mail, that I could throw it away, right? So I get it in the mail, and it was like starting with like $3,500, right? And I didn't read the small print. I took off the little sticker, activated it, and I went to work, man. I went to work.
Yes, sir.
They let me get away with it for a while, paying, because I thought it was minimum payment every month, and for a few months I was able to pay the minimum, which wasn't really a minimum. It's minimum that I made up. But after a while, they cut me off, man. Cut me off in a very embarrassing way. I was taking my family out to Red Lobster, and I was gonna pay, and it came by and the card declined a few times, and I was like, "Whoa!" Lesson learned, man. But but most importantly, Shannon, what I would say for parents in that space, kids, man, is you want to kind of gauge your kid, because if they aren't ready for either, then don't do it. Put them as authorized user. When the card comes in the mail, either shred it or don't give it to them until you're ready for them to have it. They can graduate to their own primary accounts, but you can gauge your child. So any credit card is bad if you lack discipline, even a secure card. So it's really all about, as a parent, do you trust that child to operate properly in that space?
Gotcha. Yeah, I think all of us have been victim to that first card.
Yeah, man.
You get that first card, got to go tear them all up. Like you said, go hit up the restaurants. You want to pick up the bill. Like
Yeah.
Oh, man.
Oh, yeah.
Yeah, we all fell victim to that first card. But once again, ladies and gentlemen, I am Shannon Smith here with Jay Allen today for the Successes Within Reach podcast, episode 5. We're about to take a quick break, brought to you by Breakthrough Kings, and we'll be right back. And we are back from break. So really quickly, for those that have been following the community on Facebook at www.facebook.com/SIWR podcast, excuse me, you recently saw a post letting you all know that we passed over 500 followers in just our first month being on the air, which I greatly appreciate each and every one of you. So want to do something special for a little thank you. Gonna pull the name of one of our viewers. Keep hitting that like button, keep hitting that heart button, keep hitting that share button. And our first winner for this evening is going to receive a Amazon gift card. Once I say your name on here, go and inbox us your email account, and we would do an e-gift card from Amazon to you. Our first winner for this evening is I hope I say your name right. Please forgive me if I get it wrong. Lavinia Barkley. Once again, Lavinia Barkley is our first Amazon gift card winner. We appreciate you following this show and contributing with questions and comments. Like I said, inbox us on Facebook with your email address, and when the show is over, we'll get that e-gift card out to you. All right. And we also will have one more winner, so don't go anywhere. Like I said, keep hitting that like button, hit that share button, hit that heart. Let us know that you like the information that's been provided. All right, now back to the questions. Is it smart for married couples to share credit cards or should they keep individual credit accounts? Now, disclaimer, we are not trying to start anything here at the SIWR podcast. We're just trying to get some facts from a credit and finance expert. So, once again, is it smart for married couples to share credit cards or should they keep individual credit accounts? What do you think?
Shannon, first of all, man, I appreciate the disclaimer because I do not want to start no problems. And I'm also not married either, so from a married perspective, maybe it's different. But I'm gonna tell you from what I've seen from working with married couples who are in business
Mhm.
together and who apply for loans together. First thing I want to say is the question I want to ask is to the couple is what's the strategy and what cards have you been dealt? And what those two questions mean together is this: are you both financially secure in the credit space? Are you equally yoked on in that space of credit and your credit FICO and your credit profile? Because if you're not, you can build the other up. So in that case, I would
Mhm.
if you have a spouse that's lacking in the credit space, add them as authorized user because I think it
Okay.
needs a team aspect in this space. And even let's back up first. Have y'all talked about this yet? So let's go there. Like, have y'all
Mhm.
just say put it on the table, right? Like, is that was that one of the things that y'all discussed during the courting or the dating session, the fiance session? I don't know. If you haven't seen their credit report, have a credit date. You know, drink the wine and stuff because you want full
Oh
transparency.
man.
Because and I'll tell you why I say that, Shannon. I've personally seen clients apply together. And banks and lenders have what's called, most of us have, we call it something different, but tiered pricing, like a tier, or either risk-based
Mhm.
pricing. And what that means is the lower your FICO score, the better your credit, the higher your interest rate is going to be. And we have a range.
Mhm.
So it could be, 300 to maybe 450 may get 15% interest rate. And then 451 to 600, I'm just kind of giving an example, might get 10%.
Mhm.
So that top tier credit is going to get that lower rate. I've seen where you have a spouse that's here and one is here. Now, if they both apply, I can't give you the rate for the best credit. I got to try to probably bring you down a little bit more because once again, just to reiterate this, my job is to mitigate risk. As a lender, I'm always thinking about if things go south, how can I get my money back? How can I get my
Okay.
money back? How can I be made whole? That's my as a lender, I'm thinking worst case scenario, first date. And your profile, what you're really doing to me is you're painting a picture that erases my worries.
Okay.
My job as a consumer is to put me at ease. So if I see a couple and they're kind of at a huge disparity on credit, I gotta condition it. It may be a high interest rate. It could be more cash down. It could be
Mhm.
collateral. And sometimes you have a situation to where I want collateral, but the collateral that they have to pledge to offer is not free and clear. You know why? Because they applied for something else with another bank and they took collateral first, right? So let's
Okay.
say that the collateral is a truck and that truck is wrapped up in what's called a blanket lien, which means that another lender has a blanket. Think of a blanket in your bed. They have a blanket lien over all their assets, whether it's the trucks,
Mhm.
trailers, machinery, equipment. That means that lender has the right, if they default with them, to come get all that stuff and then sell it somewhere else. So
Okay.
if you want to come to me and I want some collateral and I see something in UCC filings, which is your universal commercial code filings. If I see like a truck that's tied to you by a VIN number, I say, hey, I want that truck. Is it free and clear? Which means free and clear means you have any debt on that truck. And you say, yes, free and clear, but ABC Bank has a blanket lien over my assets. That's already a red flag for me, because it tells me if someone else wants a blanket lien over you, you're high risk somewhere. They saw a red flag. But I can proceed, but I have to get what's called a subordination agreement with the other bank, which means I have to call the other bank and say, Mr. Bank, Mrs. Bank, will you sign this document that says if they default, I get that truck. I can come get that truck. I can sell it first, and I'll pay you what. And sometimes that doesn't happen. Now, I went way off the question a little bit, but I'm just trying to give you an example of how things can go bad if one person is higher than the other. So in some cases, you apply for the loan on your own as the stronger spouse. And some banks, some mortgage lenders, they can still use the income from both people, but use the FICO from one person. So you really want to communicate what you want to see to the lender in advance and figure out what their policies are, because you can learn a lot before they pull your credit. You don't have to have your credit pulled before you have a conversation with the lender. You can, in full transparency, say, listen, this is what we got. This is what we got going on. What are our options? Should we wait a year? Should we rent one more year? Should we add trade lines? Can I add her or him as authorized user on my account? Then you put together a strategy, right? Because now you have a vision where you want to go. And I tell people, my clients, a GPS works two ways. You have to have a current destination and a future destination. So once you know where you want to go and you take responsibility for where you are, then you put together a strategy to make both of y'all stronger. And the beauty of credit is not forever. It's a math problem. It is a algorithm. It's an absolute truth. It's really a math problem. Once you understand the fact of credit, you know how to move them around over time. You can rebuild and restore your credit profile for both of y'all. And imagine two people with 750s or 800 credit scores with good income who are financially astute going in the same direction. That's what really builds households. Households build communities. Communities build cities, and cities build. I mean, it just keeps going. So, not to get political, but while we're worried about the election, which we all are for good reason, if you are not already in order financially, the president is not going to matter who the president is. Like if you're not intentional about focusing on things now for your household, your house is more important than the White House.
Facts.
So those are all things that I try to drive home to my clients, is that no matter who's in office of the White House, they have policies that they do affect. True indeed. But if you are not intentionally trying to improve, then it's not going to really benefit you a lot anyway, in some cases.
Yes, sir. Yes, sir. So the couples that are out there, remember what he said. Set a date, lay it all on the table, be transparent, and come up with a game plan. You do not want to just walk in, try to make a big ticket purchase, and somebody get embarrassed, or you end up getting charged a ridiculous amount of interest. Teamwork, people, teamwork and communication. All right, next up, what are the main factors assessed for establishing business credit? We have a lot of entrepreneurs that watch the show and send in questions, and they, have new businesses. They want to start establishing business credit. They want to know what is it that is assessed. What is it that's, looked at when they pull their report, pull their profile, so that they can get business credit established.
Right. So I have a list here I'm looking at, because you kind of want to go in sequence with, building business credit. So I'm reading this list I have, and if anybody wants this list, Shannon, I actually have it print out. It's basically the business credit building checklist. I can anybody this checklist that wants to have it, but it gives you the basics. So you want to definitely establish a business name, and when you do that, you check the Secretary of State to ensure no one has that name. And I also learned last night that you also want to ensure that no one has trademarked the name either. And Shannon, that's your space and that's your world. So you may want to talk to that. I'm not sure you can actually search that necessarily. I did read that you want to ensure that you are free and clear as far as the name goes in every aspect.
Definitely. So, I mean, as far as that goes, for trademarks and patents, you want to go to USPTO website. It's the government website. You can be as specific as you need to be. Type in names, colors, logo ideas, slogan ideas. Make sure that nobody has it registered. And then for your particular state, you just go to your state commission's website, and then you can type in the name of the business, and they'll let you know if anybody already has it registered as a corporation or LLC.
Perfect. Shannon is the man, by the way, in that space. So one day I'm gonna get to interview Shannon, and I cannot wait. I cannot wait
Yes,
about
sir.
that, man. But and you want to also discover if your business needs certain licenses. My business outside of credit restoration is logistics, and we had to get registered with, like, the DOT and things like that, and pass certain drug tests and different things that we need to get registered to run properly in that business. You want to understand what's needed. You also want to establish a domain name, and you probably want to establish your domain name maybe even before the business name, because if you have a business name and someone has that as their domain name, it may be bad for you long term, because people, it's confusing to the consumer. So you want to be easy about that. Then you want to get your federal EIN number. This is going to be the number that you use to file for business credit or to apply for business credit. It's going to be your business social security number. Basically, what that is,
Mm-hmm.
to have a physical address as well. And for those who don't have a physical address for your business, like a brick and mortar, you can go to regus.com, regus.com. And Regus, you plug in your zip code, and Regus is going to give you a listing of virtual offices and meeting spaces that you can use in your city as your physical location. Because as a lender, if I see, because I'm tell you what I used to do as a lender, I would Google Map you. I would Google Map. I would Google Map you, because here's the thing. I gotta think, if this person defaults, can I find them? Because if I can't
Mm-hmm.
find them, I can't find my money. If I can't
Yep.
find that means I gotta pay a third party like a Kane and Weiner, where some of you all might know if you have collections on your credit report, Kane and Weiner to go find you. Or I may have to skip trace you. Skip tracing is where you utilize certain things like LexisNexis and Synovus. These are databases that know everything about you, your mama, and your cousins too. Literally, they can do relatives, right? They can find you. They
Oh,
can
wow.
use similar addresses, similar name. They can connect you to people in your family, and they skip traces. They can find you. So people who skip states, I've had customers skip states on me. I've had customers go in hiding. So that all costs money. So I'm thinking long term, can I find the person? And I've had people give me an address to a blank property with nothing on it. I'm not giving you a
Mm.
loan, right? Because you just
Yep.
lied to me. That's a C. That's character. That's probably what either
Mm-hmm.
fine or I need more information from you. So in that situation, you want to have something that's more legitimate or more legitimized, and not a PO box. You can have a mailing address for your business as a PO box, but I need, as a lender, to see that you have an established location where I can come find you if need be, whether it's to repossess or to serve a court order, whatever it is. I have to be to get my money. Also, a good email address that's professional. At Gmail is great, but you want to have it at your business name. It gives the lender the impression that you're taking your business very serious, that you went above and beyond to establish yourself as a serious entrepreneur. So all these, brown sugar at, whatever else, I've seen some. I won't go into all that I've seen
Oh,
some
man.
crazy email addresses. So that's another conversation. But and see what else I
Yeah.
want to, Shannon. Make sure I didn't miss anything because I want to hit it all. So you also want to get a separate business phone number for the business,
Mm-hmm.
separate church and state, right? You want to get in the 411 directory. Once again, as a lender, I'm searching for you everywhere, and that's just it's more legitimate, it's more legitimized If you're in 411, you can be searched that way as well. And then you don't want to have any. You want to avoid public liens and judgments. So pay your bills, pay your taxes, and that's kind of where, as a lender, I'm looking for all those things to be established. Sometimes, as a new business with no business credit, I may have to pull your personal credit sometimes establish. And sometimes, based on what you're looking for, how much you're asking for, I may or may not ask for your personal guarantee. Most people want to separate themselves totally, and that's understandable. But in some cases, if you maybe lack the capacity, if you lack the experience, or if you lack the capital already in the business, I may need the personal guarantee. Sometimes the person is the strength of the business until you build a business. And also, I missed a few things I want to add too. You want to get registered with Dun and Bradstreet, and Experian. Dun and Bradstreet is the business credit bully. They're the biggest. Experian is number two. Equifax is number three in terms of tier and size and popularity amongst lenders. You want to get registered with them right away as well and start building those accounts, the net 30s, the revolvings, the store credits, things like that. And also get coaching. Get coaching because building business credit is a strategy. It takes strategy. It takes time. It's a renovation, and the word renovation puts you in the mindset of rebuilding or establishing something. So it's going to take time. So I would highly recommend a coach if need be. It's worth the investment in the business. And then as a lender as well, I'll take a little bit further past business credit. The worst thing a small business can do is think of themselves like a small business. I'll just let that sizzle in your spirit, like Country Wayne says, because if you're thinking small, you won't operate as if you're going to grow and get bigger. One thing I think small businesses should start doing immediately almost is at least establish some type of income statement or budget for the business where you're measuring and tracking income, revenue streams, and you're tracking your expenses. And number two, you want to also establish some form of balance sheet where you have your assets and your liabilities and net equity. And then as you mature in business, you can start getting, CPAs involved and things like that in QuickBooks. But at the very, very minimum, have an Excel spreadsheet at the very, very minimum. I think next after that, and then once you get that established, you can have a CPA on your staff because you want to have a team of people. You don't want to do all this by yourself. You want a tax preparer, you want a CPA, and maybe not hired, but someone that you can at least consult through them and they can review. Based on the level of money you're asking for, sometimes when I'm looking at people's business credit profiles, I have to go above and beyond their business credit. I have to go to their statements. I have to see their forecast, what they're forecasting for their business. A big one in my industry is what's your work on hand? And what is what's your future income look like on paper? Can you show me what you have locked in as far as contracts go? Can you show me the contracts? Okay, in the contract, is there a clause that says you're guaranteed certain monies if they cancel on you? That's important. And that's the higher level of lending. But like I said, as you grow, you want to think about these things because if you're doing this early, it becomes second nature. And the last thing I want to say is this: business owners, what's your bio? What's your bio? And what that is, if on paper or in Dun and Bradstreet or in Experian, you've been in business for 2 years, you're a new business. And some institutions won't lend to you under 3 years of being in business based on their risk tolerance and their risk profile. But if you come to me and say, all right, Jay and Shannon come together and we have LLC and we're doing a business of something simple, trucking, right? We're trucking and our entity is new, but Shannon has been a operations manager in that space for 25 years. And Jay, he's been a coordinator of logistics for 25 years. So together, we have 50 years of experience, even though the business is 2 years old. So that goes to the character things. You're illustrating your ability to run the business properly. As a lender, that gives me trust and eases my stress. You paying me back, even though the business is in business 2 years. You have 50 years of experience combined. So I would even add your bios in your financial statements when you give them to your bank for a loan.
That's smart. That's definitely smart. I can't stress enough the points that he made, especially for the new entrepreneurs. Have your website, make sure it's legit. Don't just throw something together for the sake of having one. That Dun and Bradstreet, I'm telling you, do not play around with it. When he called them the business credit bully, that's all facts. Like, don't play around with that account and get into the negative and start getting flagged and stuff. Like, that is major for your business. Making sure that all of your ducks are in a row as far as your finances. When you start making money, don't just go start blowing it and buying all kind of crazy stuff, and then your business is in the red and not in the black anymore. You don't want to go to somebody needing funds and your business is upside down financially. You want to look as strong as possible with your portfolio. So can't stress that enough. All
And
right,
Shannon, let me
next.
say this too, man. As far as business credit goes, if you it's
Mhm.
hard to track all this stuff. You got DMB, you got Experian. If you want to track your business credit bureaus all in one place, go to nav.com. And nav.com, you could track Dun and Bradstreet, Experian, Equifax all in one location. For one login, and it's a lot easier to track all these passwords. So it's just trying to be more seamless with the business.
Definitely. And if you need help with this, like you said, ask somebody. You can ask me. You can, again, hit me up through my website, www.theceowithin.com, or you can send me a message on Instagram at the_CEO_within. I would do my best to help you out and get you squared away before you go to whatever the financial institution is, because this stuff is super, super important for starting your business off on the right foot. All right, next up. This is a big one. What items do not come off your credit report when filing bankruptcy? There's a lot of people that say, oh, you can file bankruptcy, it'll take everything off. Then you have some people that say, well, no, there are certain items they're going to stay on there regardless. So let's settle it, clear the air. What items do not come off your credit report when filing bankruptcy?
Yep. In some cases, student loans don't come off your credit report, as well as alimony and child support. And then also
Hmm.
some tax liens as well remain on your credit report as well, even through filing, even Chapter 7, that remains on there. If you have a judgment on your credit report that results from these things, this is very specific. Debts for willful and malicious injury to another person or property, or debts from death or personal injury due to like driving drunk. So if you kill someone driving drunk,
Hmm.
you destroy property driving drunk, or anything malicious, and you have a judgment on your credit report as a result, those things would not, in most cases, be removed off your credit report. And as far as
Okay.
bankruptcy goes, this is a common internet dispute that people have, that bankruptcy is credit repair. I say it's not
Hmm.
credit repair. I said there's times when you need it. I'm not a lawyer, so I can't always say when you need it, but I think some people file it immaturely.
Okay.
If you file it, remember this: it stays on your credit report 7 to 10, right? Now you can dispute it later down the line and have it removed from your report, but the bankruptcy is still in play. However,
Hmm.
you want to start rebuilding your credit immediately when you file bankruptcy because it erases your history, right? Your profile is wiped out. So you appear to be a new person to credit. So
Hmm.
in those situations where you're in the midst of bankruptcy and cannot apply for new credit, that's when you want to start leveraging things like security cards and self-lender. You want to identify trade lines that do not require a credit pull. because sometimes when you file bankruptcy and you need to go apply for a loan, or you need to, build your business with your personal credit, the lender's like, there's nothing here to even make it. We make decisions off of facts and data, and if the facts have been removed from your report, I have nothing to really make a decision upon. So if you do file bankruptcy, start immediately starting to rebuild it and figure out ways to do that without having your credit pulled.
Gotcha. Gotcha. I'm so glad I was able to get that question in here because, like you said, on the internet, you see it disputed just about every day,
Yeah.
and a lot of people are getting misinformation. And like you said, some people are actually filing it immaturely when they really don't need to,
Yeah.
when they can just sit down with somebody, map it out, learn what to pay off, learn what needs to be removed that shouldn't be there anyway, and they be squared away and save themselves a whole lot of headache.
Yep. And they learn how to communicate. Some lenders, especially in this COVID environment, are willing to do certain things that they, maybe, like for example, my company, my full-time job, we do a lot of account modifications. We'll modify your contract in tough times, especially someone, for example, who's in the Northeast and they get snow and they can't move the equipment. We may give them skips in the winter months. And right now, it's time to get things modified because they don't want to lose you as a client. But if they can help you get over this bridge of heartache and distraught, maybe they can keep you as a client long term. So have a conversation. If you're experiencing hardships, talk to them. There are companies out there like Thrivent Financial. I believe it's like a church-based financial institution that provides, I think, free information on your finances and budgeting and mapping things out. Find the resources first before you go to a office of a lawyer to file, because in all due respect, they may or may not have your best interest at heart in that case. So try to work it out first.
Okay. All right. Once again, ladies and gentlemen, you are tuning in to the Successes Within Reach podcast. I'm your host, Shannon Smith, joined here today by Jay Allen. Once again, we're going to take a quick break and then we'll come back. We'll pick our second winner for the Amazon gift card giveaway. Continue to hit that like button, hit that heart button, hit that share button. Join in also in the conversation at www.facebook.com/SIWR podcast. We'll be right back. I'm ready to get the ball.
That's all.
All right, welcome back, ladies and gentlemen.
And that promo is fire.
I appreciate that. All right, next winner for Amazon gift card is Tony Wyatt. Tony Wyatt, congratulations, sir. You are a second winner for our Amazon gift card giveaway. Message us at www.facebook.com/SIWR podcast. Drop us a message in our inbox with your email, and we will send you out that Amazon e-gift card shortly after the show. Congratulations, sir. Again, we want to thank everybody that's been tuning in. This is just our way of showing appreciation. In our first month of being on the air, we got over 500 followers in our Facebook community, so we just want to give back, letting everybody know how much we appreciate you out there. All right. Last question for Mr. Allen this evening is, how do you get your rent added to your credit report, and how heavily does it weigh? This is another question that came from the last episode when you were on, and we briefly touched on it. And somebody sent in a question and then wanted to get more information on adding their rent to their credit report. How heavy does it weigh? Does it have major weight, or does it just help a little bit as far as their score goes? How long does it last? Things like that.
Yeah. So most companies that do it, and I give you two. One that I have access to myself through my business is credit my rent. Credit my rent. Obviously, you pay a fee. And how it really works is when you sign up for the program and you pay the monthly, they will basically they can go back as far as 2 years, back as 24 months on a rental history. Now you want to ensure that you've been on time. Obviously, you don't want to give yourself a black eye on purpose with that process. But basically, all they're doing is they're calling the landlord or the apartment complex, and they're verifying that you do stay there, and they're verifying that the owner of the property does own the property, and then proceed to report based upon the feedback from that particular owner of the property. And that's my Credit My Rent is my company. So if you want that, definitely reach out to me on that one. Another one is Rent Reporters as well. Another one, very similar process as well, almost the same exact process as well. Very low monthly investment there as well. As far as how it weighs as an installment loan, and I've seen clients typically get a boost on that credit from about, I say 25 to 50, 60 points based upon their particular credit situation. Everybody's credit profile is different. Everybody's algorithm and their profile is going to be different. So, but I've seen clients get a boost of 20 to 60 points, usually by adding Credit My Rent. What that does also, besides adding the trade line, what it does also besides adding payment history, it shows a lender that you can pay that level of debt monthly. And the example is this: apartments are not cheap, and in some cases, some of us are paying monthly more for an apartment than a mortgage would cost us in some cases. So here's the example I give is that what if you didn't have your rent reporting to your credit bureaus and your highest trade line on file was your car payment? Let's say it's 14 grand for your car, you're paying $300 a month. You go to a mortgage lender's office looking to get pre-approved for a house, and your mortgage is going to be $1,200 a month. Well, in reality, your rent might be, $1,500 a month. What shows that you can pay and handle that type of debt load. But if it's not visible to the lender, they have no way of knowing what you can do. And that speaks to that comp credit I mentioned earlier. It's comparable in terms of monthly amount, of monthly obligation. So it's just another piece to help you out in terms of information. Now, granted, if you want to get deep with this, I would recommend going to myfico.com because there are currently 28 different versions of FICO out there. And they just released FICO 10 and FICO 10T. And the T stands for trending data, which means they look at your data on a trended basis, not just a snapshot in time. And they're able to look at trends and how you handle your credit, loans, debt consolidations, and things like that. And I say that because each FICO is going to handle reporting a little bit differently in how it's built to handle credit. And you don't know which version your lender is going to pull. Once again, you want to communicate in advance. Say, hey, what version of FICO are you pulling? And maybe you can try to figure out which algorithm they're using in that pool, so you're better prepared when you walk in. Now, at a very, 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 very base level, don't stress over the FICO version. Here's why. If you handle payment history, which is 35% of your FICO score, if you handle credit card utilization, keeping your credit cards utilization under 30%, preferably 10%, right? That tackles more than half of what your FICO score is comprised of, right? Length of history comes with time. Credit mix, you can do that by adding different kinds of trade lines to your credit profile. And what I'm trying to put you in the thing, I'm trying to show you something. You're in the driver's seat of this thing, right? The only thing you can't really affect is the time history-wise. You were born when you were born, you started when you started. But you can affect credit history, payment history, utilization. You can affect how much new credit you have on your profile. So don't stress over the versions. If you handle those big chunks of the algorithm, you will have good credit under any version of FICO, even under Vantage, which is what Credit Karma uses. So
Okay.
don't stress over those things too much. Those are the minute details, versions, and also another nugget. Insurance companies also pull a version of your FICO score under their own variation. However, they give you your rates, like your insurance rates for cars and houses, and your FICO plays a part of that. But once again, if you handle those chunks that you can control, you're empowered either way.
Got to stay ahead of the game. Definitely. Definitely. All right. That concludes our Q&A with Mr. Jay Allen. As we mentioned before, he's been in the finance service for 15 years. He's a serial entrepreneur in the credit restoration business as well as logistics and trucking. He owns Allen Financial Solutions. Um, Also, he's an author. And, we hit on it last time, but also want to give him, a few moments here again to let you all know for the new viewers to this episode about a book that he wrote that just exploded a few months back on social media. So go ahead and let him know, sir.
Yes, sir. This is the HBCU experience. It's an anthology in the collection of stories from students from the 1960s to 2000s of their Black college experience. My college is North Carolina A&T, and in North Carolina, this is our version. This can be found on Amazon as well. You can also find it in my link tree when you go to allenfinancialsolutions.biz Instagram or through that. Yep, right there. Instagram, I can be reached at J83Allen. And on Facebook, I am just J Allen. And that link to that book is also on my page as well. And the power in this book is that it gives us as African Americans firsthand opportunity to tell our stories from our perspective. No one's telling our story for us. And if you're familiar with Greensboro, North Carolina in the 60s, there was a huge civil rights movement there at the Woolworth sit-in. And there was a lot of attention and a lot of action that took place on my campus. So you have those people who lived through that in this book up until now. So definitely check it out. Love and support. HBCU Experience Anthology on Amazon, Volume 1.
Nice. Y'all make sure you go out there, check that out, pick up that book and support. I'd like to thank you again for tuning in to the Successes Within Reach podcast, episode 5, Finance and Credit Conversations with Jay Allen. Once again, just reminding you all, he will be back next month. He'll be back once a month for these conversations. So keep sending us your questions, keep sending the comments, letting us know if you love the episode, anything you want to see added, any questions you want us to ask for the next time he's here. Remember, you can always join in the conversation at www.facebook.com/SIWR podcast. This podcast will be uploaded on Spotify, Google, Anchor, Apple Podcasts as well on Saturday morning and on YouTube as well. You can always go back to our Facebook page and watch the live replay. And with that, we tell you be safe, be blessed, be great, and we will see you next Thursday at 8 o'clock.